You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, let's stick along with our strategy theme here. The last couple of weeks, we've looked at a few trades that were based more so off of volatility reasons. We were looking at earnings. What might we do around earnings in Amazon? Last week we had the VIX index up fairly high, inflated, even though the market was starting to come back. So let's look at doing some credit spreads, okay? So this week we're at the tail end of earnings, and one of the companies that popped up on my radar is Lowe's company. Lowe's earnings on the 26th of this month, and I should mention that we are taping Options Playbook Radio. The markets are closed right now. It's February 12th, and Lowe's closed today at 125.03, up $2 exactly. And I like the fact, one of the reasons why I'm going to pick this underlying is that the stock actually closed right at a strike price, 125. So it makes it fairly simple to talk about. And we have a $125 stock. We have a small inflation as far as implied volatility is concerned, considering that when you look at the earnings are going to be after the February 21st expiration date. So we're talking February 26th. That means we're looking at February 28th as the expiration that will contain the earnings. So at this point in time, that expiration, that volatility of the at-the-money option contract is trading at about 30% implied volatility. And the volatility of the 9-day option contract is trading right around 18% implied volatility. It's about double the vol, but as far as Lowe's is concerned, the high for Lowe's implied volatility going in around earnings previously is up around 50%. So I think there's potential for the implied volatility to go higher on Lowe's going into earnings. Home Depot had a decent earnings report just recently. So with that outlook and that thought process, well, maybe we want to find a way to get long some option contracts at a little bit lower rate. And so the trade that we're going to look at today is actually going to be a diagonal spread in Lowe's. We're going to do it on the call side. There is going to be a small requirement when we do this trade, but our whole goal here is that we're going to sell an option contract that we hope will expire worthless, which will allow us to remain long a call option going into the earnings report with a few days left after the earnings report. So if we do that trade, one of the things that we want to focus on is the delta of the option contract. And if you're selling options in the near term, we're going to be selling an out-of-the-money option contract, the delta is going to be smaller on out-of-the-money option contracts on the shorter expiration, same strike, than on out-of-the-money option contracts. It all has to deal with the concept that delta is the probability of the option contract finishing in the money. Okay, I said that fairly fast, so I'll say it again. Delta has the concept, not the textbook definition, but ideally delta is kind of thought of as the probability that an option contract will finish in the money on expiration. So this theme holds true when you think about out-of-money options. If you're trying to think of delta as the chance of it finishing in the money on expiration, time is your friend, right? It gives you a chance for the stock to actually get to the out-of-the-money strikes. If there's a shorter time frame, there's a lower probability. If you have more time for it to actually move, you're going to have a higher probability, and hence delta goes with that. So when I'm setting up my long diagonal trade, that means that we're going to be buying different strikes with different expiration. We're going to be selling one option and buying one option. So here's the three expirations that I'm going to talk about today. We're going to look at the February 21st expiration, which is 9 days away. Then we're going to talk about the February 28th expiration, which is 16 days away, and that is the closest to the earnings report. And then the expiration that we're actually going to use is we're going to jump all the way out to the March 27th expiration, which is 44 days away. All right. So if I look at doing the short-term option contract, the market right now, as I said, it's Wednesday. There's 9 days remaining to expiration. The market has closed, so you got Thursday, Friday, and then you got another 5 full days of trading before that expiration date. If I look at that and I look at the 120 strike, we're going to call the stock at 125. We're going to go 1 point out of the money, look at the 126 strike. We'll see that is actually trading for $1. So we're getting some decent premium with only 9 days remaining to expiration. So we're going to be selling that option contract. And the next thing that I'm going to do then is I'm going to go over and look at the delta. And the delta of that option contract is 40.40. That is the delta. So now my option contract that I'm going to buy to try to mitigate my risk, I want it to be higher than 0.40. I want the option contract that I own to move move quicker than the option contract that I'm selling. And hence the reason is that if the market does come up to the 126 level, which would be a 1 point move, I want this trade to be profitable. And then I'm going to get out of it before I get into earnings. It's going to be that simple. Now, if the market just stays where it's at, all right, because I'm going to make a dollar profit if the stock is below 126 on this February 21st expiration option contract. So our ultimate goal of doing this as a diagonal trade, the strategy overall, is that we would really like to just get long a call option on a longer-term option contract at a lower price. We know implied volatility is most likely going to increase as we approach the earnings. So one way that we can offset that and still get long a call is to hopefully sell some shorter-term premium and use that premium. Hopefully that decays at a solid rate going into expiration, because we only got 9 days remaining to expiration, and we can capture that dollar to help offset some of the vol premium that we have to pay for the longer-term call option. Okay, so like I said, we look at the 40 delta, and we're going to try to buy an option contract that has a delta that's higher than 40. So I'm going to skip the February 16th expiration date, and one of the reasons why is, as I mentioned, that implied volatility is at about 36%. And I'm going to actually go all the way out to the March 27th expiration. The implied volatility there is 26%. So even though I'm going to still be paying some juice relative to the option contract that we're selling, I like the concept of being out further in time because we're going to get a slower just overall theta decay. Vega is still going to be a big issue. We're still going to have to deal with a volatility crunch. But if I go out further in time, I don't pay quite as much vol premium, relative is a key word there, but I still get much slower time decay. So I can buy the actual 127 strike call option with the March 27th expiration, 44 days away, and the midpoint on that option contract is $3.85. I don't mind that much. If I'm looking at this trade overall, $3.85 is not a bad price. And then you think I'm going to try to bring in $1 approximately from selling the near-term call. Now I'm mitigating my risk down to, or my overall cost, I should say, to $2.87. Now here's an important point, and this is what's hard to kind of understand when we're looking at diagonals, is that we are selling a 126 strike call, and we are buying a 127 strike call. We are still doing this for a net debit, but our obligation is at 126. Our right is at 127. That means this is acting a lot like a short call spread. We're just doing it diagonally. Most short call spreads, if you do them in the same month, you're going to bring in a net credit. We're paying a net debit. But one of the things that protects us here is we're still long delta. We're still positive delta on this trade. So if the market does start moving against us, we should be profitable. And by against us, I should say there's not necessarily an against us in this scenario to start with, but if the market starts drifting towards our short strike of our February 21st expiration, the short-term expiration, this should be beneficial to us because our longer option should move faster with more delta than our short-term option contract. Now, we just don't want it to go against us. If that stock gets to 126.5, 126.25, we're just 126. We want to get out of the trade. Our ultimate goal, the best case scenario here, is that 9 days from now, on the options expiration, it stops right at 126. That front month option contract expires worthless, and I'm long my back month option contract. That's the ideal scenario. But in this instance, that's the way we're going to approach this trade. So it's an interesting way to try to get long some premium around in earnings on a company that you might be bullish on overall, and that company is going to be Lowe's. So let's summarize the trade. We went into great detail about the setup, and I personally think the diagonals are probably the hardest trade to understand, especially for beginning investors, because you really need to understand how options are priced. So with that said, I want to emphasize this is not meant to be a recommendation. On Options Playbook Radio, we're just trying to look at certain scenarios where one of the 40 plays inside the Options Playbook might apply. And when I'm thinking about multi-month expirations, I don't necessarily treat them. A lot of people talk about it as a time decay trade. I always like to look at them as a volatility play. I want my back month option contract. I want to be in a scenario where that could increase in volatility. And I want my front month option contract to be in a scenario where that might decrease in volatility. I care more about volatility crunch in my diagonals, in my calendars, than I do about the actual time decay. Now, you throw in the benefit that short-term options usually decay at a faster rate than back-term options, and yeah, that's another little benefit, but you still got to be right on your forecast. And volatility has a tendency around in earnings especially to affect the option price even more than time decay will. All right, so here's our trade. Let's summarize it. We're going to look at a diagonal call spread. We're going to be selling the Lowe's February 21st, 126 strike call. And at the same time, we're going to buy the Lowe's March 27th, that's 44 days away, 127 strike call. The midpoint, with the markets closed on Wednesday, February 12th, is trading for $2.90. The max risk of the trade will be that net debit paid, $2.90, plus the difference between the strikes, which is $1. So $3.87 would be the max risk, but we really want to get out of this trade if in the first 9 days before that short expiration date, the front month option strike actually gets hit, which is the 126 strike. Stock right now is exactly at 125, and that would be our scenario. So why are we doing this trade? We're doing it because we think that the stock will kind of settle into this little price going into earnings. We see an opportunity here. We can sell a 126 strike call and still get $1 for that. The back month option contract still has potential to have an increase in implied volatility going into it. We can go all the way out to the March 27th strike, and we're still only paying $3.85 for that. And so our goal here is that we can get long a call option in Lowe's going into earnings at a discounted price. All right. Well, that's going to be it for this episode of Option Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.